The U.S. dollar is on a run. The currency is having its strongest start in 5 years on the heels of positive economic data. Well, this comes as the Japanese yen, long considered a safe haven currency, is paring losses after it dipped to a 9-month low. Joining us now is Mark McCormick, Director and Global Head of FX Strategy at TD Securities. And Mark, when you take a look at this surge that we have seen in the U.S. dollar, why are we seeing a rally right now?
Well, I think it's two critical factors. The first one being the most important is probably the impact of the coronavirus. People have very little understanding about how this is going to play out in the markets and how much impact it's going to have on the global economy. There's guesses around this when this pandemic will peak, and we can try to guess how much time that'll take and when the global economy starts to recover. But the problem here is that the markets were very bullish coming into the start of the year on the global growth story, and the coronavirus is essentially throwing a monkey wrench into that. The second side of the story is the outperformance of U.S. equities, which is linked to the U.S. political environment. And that's the other thing that's driving the U.S. dollar higher, is just the fact that U.S. equities are outperforming everything else.
Mark, currently where it's trading right now, do you think the U.S. dollar is overvalued?
It's clearly overvalued. I think that's one of the things you want to think about on slower moving metrics and even longer moving metrics. The dollar is overvalued. The question is, why is it overvalued? And again, I go back to the U.S. equity story. As much as President Trump has liked to say he wants a weaker dollar, his macroeconomic policies in turn have strengthened the dollar. We've had global trade wars, we've had tax cuts, we've had corporate tax repatriation, which has been very beneficial for U.S. equities. And the point is that I think U.S. risk assets like corporate bonds, credit markets, and U.S. equities are just the last thing that people are investing in. I would call it, people in the market call it the Tina effect. There's just nothing left. There's no other alternative. So essentially, the strength of the dollar really kind of reflects the asset allocation that global investors and U.S. investors have put into the U.S. equity market.
Mark, you mentioned President Trump's argument for a weaker U.S. dollar, just in terms of what that would mean for the U.S. economy, U.S. companies. How do you see that playing out? And would that be a bad idea, I guess, for the U.S. economy?
Well, again, the valuation case here is that the dollar is overvalued. On our metrics, again, the slower moving ones is about 10%. But the strength of the dollar, I don't think, is going to have a major impact on manufacturing. I think one of the things that people tend to kind of conflate in the currency market is they still think some of the old rules apply, which is a very simple way of saying if you have a weaker currency, it benefits your export markets. When you think about the interconnectedness of global supply chains that we've seen around the world kind of moving together since the 2000s, essentially that model is broken down. So, even if you have a weaker currency, you're not getting a major boost to your manufacturing. So I think the argument here is that as long as President Trump is delivering what seems to be positive growth and positive equity-style policies, those are going to benefit the U.S. dollar kind of regardless of the valuation right now. And most importantly, with the impact of the coronavirus and the impact that it's having on the supply chains in China and also the spillover effects in Europe, we just don't know what the state of the rest of the world is. And so, if the rest of the world can kind of get its mojo back, start to grow and see a V-shaped recovery in the wake of the coronavirus, then the dollar could weaken because the valuation story becomes important. But right now, that's not the case.
All right, Mark McCormick of TD Securities, thanks for joining me today.
For having me.